Good morning, everyone, and welcome to our 2026 Midyear Outlook webinar. We are here today with Emilio Jack Marone, Principal and Co-founder of One Financial Services, alongside with Robert Pretapapa, Partner at One Financial Services, as we all welcome Vice President, Head of OCIO, Andrew Beatty. You are invited to submit questions by using the icon at the bottom of your screen. Now, Rob would introduce our guest speaker.
Yeah, thanks, Suzanne. Good morning and welcome to One Financial Services 2026 Mid-Year Outlook, presented by Andrew Beatty, Head of Outsourced Chief Investment Officer Services at LPL. Over the past 2 years, Andrew and his team have gone through great lengths to better understand One Financial's investment and portfolio philosophies and how they impact our clients. He and his team at LPL have had a great impact on our financial advisors' ability to provide customized portfolios, and timely communication about our decisions related to those portfolios. Andrew is a fellow member of One Financial's investment committee, which we meet monthly to discuss current economic conditions as well as portfolio statistics and benchmark performance. During today's presentation, I encourage anyone who may have a question to pose them in the chat. I'll be monitoring those questions and we'll make sure they're asked before we close for the day. Andrew, welcome.
Thanks, Rob. Looking forward to it.
Yeah, us too. So thank you. I guess I'll start it off. The second quarter was eventful again. Can you walk us through what happened on a market level during the quarter?
Absolutely. I think calling it eventful is probably selling it a bit short. It was pretty volatile. We saw that geopolitics continued to dominate financial markets. In the middle of the quarter, however, we did see news of a de-escalation or the memorandum of understanding beginning to affect markets positively. So investor sentiment really turned decisively positive, specifically in growth equities. So in the U.S., the S&P 500 advanced more than 15% during the second quarter, and that's one of the largest gains for the index over a single quarter in years. Large and small caps in the U.S. were led by growth companies, with the Russell 1000 Growth Index, which is our proxy and our benchmark for large cap growth, outperforming the Russell 1000 Value Index by almost 3%. And then in small caps, the Russell 2000 Growth Index, which is our small cap growth benchmark, outperformed the Russell 2000 Value by more than 8%. So we really saw a reversal of what we saw in the first quarter, which is where value outperformed growth. And in the second quarter, we saw that completely flip where growth outperformed value. Elsewhere, international equities advanced, specifically emerging markets, and that is dominated by the AI trade in Korea, China, Singapore, etc. And those advanced more than 24% during the second quarter. So a massive rebound in emerging markets due largely to the continued AI trade that we've seen over the last couple of years. There was a lot of continued enthusiasm around AI and the capex and the spending there, which we'll touch on later. But we did see investors start to broaden out their interest in other parts of the growth economy and the growth market. Bond markets were positive, but only slightly. The Bloomberg US Ag, which is our investment grade benchmark for the bond market, advanced 67 basis points, so less than 1% during the quarter. But ultimately, that is a result that investors had more of a risk-on approach in markets and looked towards growth equities. But the real news here is what's going to happen in the second half. So we wanted to start there and start with the economy. And you will notice that there are a number of different things that we're going to speak about. The first of which, though, in the economy is the growth of the U.S. economy. We continue to see solid growth, and that is kind of counterintuitive to a lot of people who expect that when we have events like the war in Iran or the war in Eastern Europe and Ukraine, that that's going to have a significantly negative impact on both markets and the economy. And that's not what we're seeing. As you look at the chart on this page here, in the US, we have the benefit of sustained spending, and that spending is really what we think will propel the market forward, the economy forward. If you look towards the bottom in our forecast for the second half of the year, we are expecting growth above 2%, which is very solid in terms of economic growth. A lot of that being led by services and goods spending. It's the consumer that's really powering this economy, and it's coming from multiple places. Baby boomers are spending far more at this point in their life than previous generations. Also, the millennials who are entering into the point where they are able to spend and have more disposable income are continuing to spend. Now, it's largely being led by the upper end consumer. I think we've all heard the discussion about the K-shaped economy, but that upper end consumer is really propelling the economy forward. We do expect, like I said, the economy to continue to grow, which means that we are not projecting, at least our base case is not for a recession, because we're expecting about a 2% growth rate over the second half of the year. The second part of the economic landscape that I'll touch on is the labor economy, and that's what we're looking at here. And it's the expected job growth as we go through the second half. Now, we do see positive job growth, and that's absolutely true, but it is lower than what we saw coming out of the immediate post-COVID period of time. We're not seeing the growth in payroll, so we would consider that a softer job market, not a negative job market, but a softer job market because we do continue to see growth. And a couple of things that we want to point out. One, obviously, we are seeing growth. It's just lower growth than what we were seeing previously. The other thing is that that might not be a bad thing. There has been a material decrease in immigration, and so the number of jobs necessary to contain or to sustain full employment is probably much lower than it has been previously. So, regardless of our thoughts on immigration, and that's getting into a political landscape that I don't really want to touch, what we're seeing is the expectation for job growth has been reduced, but there is still growth. The issue that we're seeing potentially is that the number of hours worked for employees is below the pre-pandemic levels, and more people are dropping out of the workforce. So those are two things that we see as softness in the labor economy. And if those continue to decline, that may signal that there might be a broader slowdown in 2027. But for the second half of 2026, things look pretty good. So I'll jump into the stock market now. I think we've all seen the volatility as we enter into the third quarter, what's been going on, and some of that has been a pullback in the AI related stocks. But when we think about what's going to propel equities, it's not the algorithms, it's not the automated trading, it's the absolute fundamentals of what we see in the marketplace. And we mentioned it earlier, but the spending and the capex that's being spent in technology and in the AI build out, which you see on this page, is enormous. At this point, from just the top five hyperscalers, which is all we're showing on this page, the spending from those five companies is expected to eclipse $900 billion in 2027. And as we go through this quarter's earnings results, we're actually seeing an increase in that. So we should be pushing closer to $1 trillion in spending from just these five companies in 2027. That's up from about $150 billion in 2023. So there's been a material increase in spending, and we think that will continue to be one of the dominant drivers of the equity markets. But like I mentioned earlier, we do expect to see that benefit, that tailwind for stocks broaden out beyond just the hyperscalers and the chip companies into what we're kind of calling the picks and shovels of the development of the AI data centers, the AI boom. So think power companies, think industrial mechanics companies, measurement companies that go into creating the semiconductors, et cetera. Those are all companies that should start to benefit as well as the hyperscalers and the memory chip makers that we've seen. Now, spending is great. We all love to see spending, but the question is, will that spending result in earnings? And if the first quarter earnings results, which were announced during the second quarter, are any guide, then yes, it is starting to materially impact positively corporate earnings. As you see on this chart, the expectation for earnings has increased dramatically after the second quarter. You'll see what we're kind of calling a step change there to the far right with earnings expectations. And that's because during the second quarter, we got first quarter earning results that showed about a 30% year over year EPS gain for the S&P. So earnings per share gain for the S&P 500. That is an enormous increase when we were expecting somewhere around 12 to 13% increase. So very, very strong results. As we work through the second quarter earnings results, which we're seeing right now during the third quarter, we're continuing to see that very significant increase in earnings for the S&P. So if we expect that earnings continue to grow, and one of the things that's a fundamental driver we think of stock performance is earnings growth, then that should provide a tailwind for the broad equity market, specifically in the United States. And then in the other countries that we mentioned earlier, Korea, and other places in the emerging markets that really dominate a lot of the AI build out. But there are some questions. People always think, and they've asked us multiple times, are stocks expensive? And so that's one thing, if you're thinking about the valuations, that could hold back or could be a headwind to stock performance. So we looked back, and this is going back 10 years in the S&P 500 to see what the earnings yield valuations were for the S&P. And what you'll see here is that while they've increased and while they're clearly more expensive than they used to be, they are still very attractive on a relative basis to history. So that level of earnings growth that we're seeing, combined with the increase in capital expenditures from companies plowing money into growth-oriented build-outs, whether it's AI or otherwise, and then the combination of that with a valuation for equities that doesn't seem as stretched as we may think really provides a positive backdrop for equities as we go into the second half of this year. Now, that doesn't mean that we're going to go all in on equities and get out over our skis and put all of our eggs in that one equity basket. We want to maintain diversification. And that's one of the things that comes up during our monthly investment committee meetings. It'd be very easy to follow momentum, to chase that momentum. But because we want to maintain diversification, we want to be risk aware, we're going to maintain some exposure to bonds in most portfolios. But what we've talked about is that bonds right now, and I think we just saw it yesterday in the Fed's most recent committee meeting, is that the Federal Reserve is in a bit of a sticky situation. If we remember what the Fed is basing their information on, it's on two mandates. The first is full employment. The second is economic growth and inflation. So clearly we are at basically full employment right now, so that's not an issue. But the inflationary data that we're seeing right now remains, we'll call it generously sticky at this point. It is higher than we expected. It is higher and prolonging to be higher than we expected coming into this year, largely because of the increase in oil prices. And that does have an impact on inflation. If you look to the right side of this, we do think that the geopolitical shocks right now will keep inflation higher for longer. Obviously, as the conflict in Iran has re-escalated, that is going to continue to push oil and gas prices higher globally, which will have an inflationary impact. But we don't think, at least as of right now, we don't think that that's going to push the Fed to become more hawkish and raise rates this year. As of right now, our base case is that the Fed remains on hold through the end of this year. That is barring any sort of unexpected significant increase in inflation that they may have to combat. The reason we don't think they will do that, they will raise rates, is because the hawkish commentary coming out of the Fed right now has really pushed the market to raise rates in the bond market. So what we're seeing is the market itself tightening as opposed to the Fed raising rates to tighten the bond market. So the Fed is leading the market to what it wants rather than having to act, which is, we think, overall effect. About bonds, however, we don't think that we're going to see a lot of price appreciation in bonds. Where we think we're going to see some benefits is simply in sitting back and clipping coupons. We are provided with a significant amount of yield in the bond market right now, so we can hold on to bonds, not take a lot of duration risk, not take a lot of yield risk by going into high yield securities that much, and still sit back and get 3.5, 4.5+% yield on those bonds. That's really attractive, both as a ballast to equity volatility, but then also for investors who are looking for that yield to really benefit them and to sustain their lifestyle. So that's what we're expecting. We're not expecting the Fed to hike rates, but we want to make sure that we remain diversified, we remain and have exposure to bonds across both the duration spectrum, the quality spectrum, etc. As we are looking to what the market expects, however, the market is now pricing in 1 to 2 rate hikes by the end of the year. Probably in September and December is where the market is pricing. We differ from that a little bit, primarily because while we are seeing dissents in the Fed committee meetings, yesterday there were three pushing for a rate hike. We think that Kevin Warsh, the new Fed chairman, obviously has a bit of a mandate from the White House not to raise rates. We don't think the committee, again, using their rhetoric to push the market to tighten itself, we don't think the committee will act to raise rates at this point. Again, barring any sort of change in what we see from inflation. So I'll pause there and see if there are any questions, Rob. I know I covered a lot there, and there's a lot going on in the marketplace. We're seeing massive increases and decreases almost on a daily basis based on either developments in the Middle East or rhetoric coming out of the White House, developments in Congress, et cetera. And we will see a further volatility, we think, based on the fact that midterm years tend to be incredibly volatile for equity markets. So I'll stop there and see if there are any questions.
Thank you, Andrew. Very insightful. I do have a question. It was one of the earlier topics that you covered, the artificial intelligence spend and the hyperscalers reaching nearly $1 trillion. When we see that kind of spend, what is the expectation that the market, what's the return on that spend? Where are companies looking to make gains with that? I mean, you hear a lot of things about it's going to cost jobs or it's going to be in productivity gains. Can you share a little bit of insight there?
Sure. Yeah, I think that what we're seeing right now is companies pushing for that AI spin to build efficiencies, whether it is in call centers that are now being moved over to AI or agentic AI to handle call center questions coming in. That's a quick and easy way, and kind of one of the more simple ways that companies have been integrating AI into their businesses. The other thing is if you think about industrial companies, there are a lot of things that can be built in AI that then become an efficiency gain for them in development, in manufacturing, in sourcing, et cetera. The other place that we've seen this is in developers. We can use different AI programs to create and to write code. And so the need for a massive army of coders and for developers at companies is diminishing. So those are the areas that we're seeing companies really spend their CapEx to develop AI capabilities. Now, the job impact, there are going to be some negative impacts potentially. The expectation or the magnitude of those impacts is hotly debated at this point. But right now, we don't see that having a material impact on the labor market or on the job economy as we go forward.
Thanks, Andrew. Very helpful. Switching gears a little bit to the earnings and the earnings growth that you highlighted. So it has been a great quarter as companies are exiting this most recent earnings quarter. If you have any insight on how that translates to profits for these companies, or earnings are great, but does it translate into record profit margins as well, which tends to also help stocks go higher?
I think that's the goal, right? Every company wants to generate top line earnings, but then ultimately we're looking at the margin and the profitability, so at the bottom line numbers in the earnings results. And what we have seen, and obviously this varies by sector, but what we have seen as increases in efficiency, and from a couple of things. One, AI, obviously, Two, there was some pressure, and people thought there was going to be pressure on the bottom line from the impact of tariffs, the increase in inflation, the increase in oil and gas prices. But one of the ways that the U.S. has been able to withstand specifically the increase in oil prices globally is that we are a net exporter of oil. That gives us a little bit of insulation and gives the companies that operate here a bit more insulation from the fluctuations in the global oil market. So that is an expectation that we have, is that margins for these companies should incrementally increase, not significantly. We're already running at a pretty solid margin across the board, but there will be some incremental increases. And as companies begin to integrate more AI, as they begin to potentially let go of some of their workforce or shrink their workforce, that margin just expands. So while earnings we do think leads to stock returns, obviously the underlying margins that they have and the bottom line growth in profits is going to be along for the ride with those earnings.
Great. Great. Thank you. If we can just touch on the bond market, I think you highlighted that the expectation is from LPL research is that interest rates are going to hold tight for the near term, but the market is pricing in an increase outside of the actual Fed increase. Can you just break that down to like a client level? Does that mean
Sure.
mortgage rates are going to go higher, loan rates are going to go higher, deposit account rates are going to go higher or not?
And so one of the things that we always want to remember is that those types of rates that you just mentioned are typically tied to the 10-year bond, 10-year treasury yield. So if the treasury yield increases, which we have seen, then those typically will increase. It's not a direct correlation between what the Fed's target rate is and what the Fed funds rate is, and those individual rates that you mentioned, both for mortgages, cars, et cetera. So what we're really watching is the 10-year treasury yield, and that has increased. So that will put a little bit of pressure on consumers potentially for as those rates rise. But we do think that the 10-year will be somewhat range bound. So we don't expect a significant increase in yields. So that will probably mute the impact to consumer lending that we've seen. The other thing is that if we think about the way that the bond yield curve is structured, if you think the shorter end of the curve, so like your 90-day T-bills, 2 years up through your 5 years, 10, et cetera, and out to 30-year duration or 30-year maturity bonds, that curve should be upward sloping. And the steeper that curve, the better the banks are positioned for their net interest margin. If you think about the way they operate, they borrow short, they lend long. So if that expansion in the yield curve continues, which is what we've seen following the Fed's meeting yesterday, that could potentially be a pretty attractive point for financials in the marketplace.
Great. Thank you. I'm not seeing any additional questions. If anybody out there has questions and they want to ask an advisor, I'll always reach out directly to our team here. Andrew, I want to thank you for your time. Appreciate you taking the time to do this today. Suzanne, I'm going to toss it over to you for some closing remarks, and thank everybody for joining us today.
Great. Thank you, Rob. And thank you, Andrew, for sharing your insights and all of this great timely information with us. Also, thank you to everyone who joined us today. As soon as it's prepared, we will share a replay link of this presentation via email, and the same link will also be available on our website. Thanks so much for your time today. We'll see you next time.